trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Whatever the market went down, I went down more. But over the long term, the upside is more than the downside. So you're going to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
How am I supposed to predict the economy? You certainly remember the recession of 82.
Yes.
In 1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen.
Yeah.
All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
There's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever kid was under the damn curve. I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is, and I'm ready for questions. So I think that's, but you should study history. And history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. If you understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it, 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen.